welcome to the Ashiana Housing Limited Q4 FY26 earnings conference call hosted by Valorum Advisors. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. I will now hand the conference over to Ms. Hina Khatri from Valorum Advisors for opening remarks. Thank you, and over to you.
Good morning, everyone, and a very warm welcome to you all. My name is Hina Khatri from Valorum Advisors. We represent the investor relations of Ashiana Housing Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings conference call for the fourth quarter in the financial year 2026. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's belief as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements and making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Varun Gupta, Whole-time Director, and Mr. Vikas Dugar, Chief Financial Officer. Without any delay, I request Mr. Vikas Dugar to start with his opening remarks. Thank you, and over to you, sir.
Thank you. Good morning to everyone, and a warm welcome to all of you for joining our earnings conference call for the fourth quarter and the financial year 2026. The Indian real estate sector witnessed strong momentum during FY26, supported by resilient residential demand, premiumization trends, and increasing preference for branded and organized developers. Industry consolidation continued to benefit financially disciplined players with strong execution capabilities and established market positioning. The senior living segment also continued to gain traction, driven by changing demographics, rising urbanization, and increasing preference for community-based living among senior citizens. With limited organized supply and rising awareness, the segment offers a strong long-term growth opportunity for developers focused on this category. FY26 was a landmark year for the company, driven by strong demand momentum, healthy launches, robust execution, and disciplined business development across key markets. I'll first take you through the operational highlights for the quarter and the full year, followed by financial performance. Starting with operational performance for the quarter, the value of area booked stood at rupees 1290 crores, reflecting strong growth of over 225% sequentially and 124% year-on-year growth. The performance was primarily driven by successful launch of Ashiana Housing Phase 1 and Phase 2 in Gurugram, which contributed booking value of around 833 crores at launch. Average realization during the quarter improved significantly to rupees 11,566 per square foot, up 71% year-on-year, largely driven by high realization from the Gurugram launch. Execution momentum also remains strong, with equivalent area constructed at 6.65 lakh square foot, increasing around 60% year-on-year and remaining broadly in line with committed timelines. The company also maintained healthy cash flow generation with pre-tax operating cash flow of rupees 167 crores during the quarter, up around 7% year-on-year. In terms of business development, the company further strengthened its senior living portfolio during the quarter through acquisition of 8.83 acres of land in Raigad, Maharashtra, with estimated sales potential of around rupees 450 crores. Additionally, the company entered into an agreement for another land parcel in Panvel, Maharashtra, with estimated sale potential of around 1,000 crores. Moving to full year operational performance, FY26 was one of the strongest years in the company's history. The company achieved its highest ever booking value of rupees 2,421 crores, reflecting growth of 25% year-on-year. The senior living segment also delivered record bookings of rupees 570 crores during the year, registering growth of around 55% year-on-year and reflecting sustained demand momentum in the category. Execution remained robust throughout FY26 with EAC increasing 30% year-on-year to 26.19 lakh square foot in line with project commitments and execution schedules. Customer collections reached an all-time high of rupees 1762 crores during the year, supported by timely execution, successful launches, and strong collection efficiency. The company also maintained strong launch momentum across Jaipur, Bhiwadi, Gurugram, Chennai, Pune, Jamshedpur, further strengthening its project pipeline and market presence. The company expanded its senior living portfolio through strategic land acquisitions in Chennai and Maharashtra, adding development potential of over 26 lakh square foot, with estimated sale potential of around rupees 3,200 crores. In addition, Ashiana Aroham Gurugram received funding support from IFC through allotment of rupees 100 crores of listed unsecured redeemable NCDs. During the year, the company also settled a long-term dispute relating to Project Maitri, Kolkata, and received 18.5 crore as FNF against the security deposit and related expenses incurred. Coming to the financial performance, total income for the quarter stood at 335 crores, registering growth of around 46% year-on-year, primarily driven by handovers across projects in Jaipur, Pune, and Chennai. EBITDA for quarter stood at 35 crores, registering growth of around 19% year-on-year, while EBITDA margin was at 10.43%. PAT stood at 21 crores, remaining broadly stable on a year-on-year basis, with margin around 6.26%. For the full year FY26, total income increased to 1,187 crores, more than doubling compared to FY25 in the wake of higher deliveries. EBITDA stood at rupees 176 crores, registering growth of 281% year-on-year, while EBITDA margin at 14.85%. PAT for FY26 stood at 118 crores compared to 18 crores in FY25, while PAT margin improved to 9.93%. Further, pre-tax operating cash flow for FY26 stood at 577 crores, which also was highest ever, registering growth of 34% year-on-year, reflecting strong sales momentum and healthy collections. Overall, FY26 was characterized by strong operational execution, robust demand across segments, disciplined expansion in the senior living business, healthy cash flow generation, and significant improvement in profitability, positioning the company well for sustained long-term growth. With this, I would like to open the floor for Q&A session. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants who wish to ask a question, please press star and 1. We take the first question from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the team. I have two questions. The first question to Mr. Gupta is, what type of strategic levers are you prioritizing in FY26-27 to expand Ashiana's residential housing footprint across Tier 2 and Tier 3 cities and to strengthen customer engagement in senior living projects and manage risks from regulatory changes and construction costs inflation? That's my first question. I'll ask the second question after this. Thank you.
Hi, Sukrit. So I see sort of three questions in there. I will take the last part first with respect to construction cost and regulatory compliance. On the construction cost piece, inflationary increases will be impacting costs going forward. I don't think there is much to say with inflation increasing in wholesale prices. We hope that some of those might cool down if geopolitical situations improve. That said, I think the price points that we have been able to achieve in our projects leaves sufficient room that even if costs increase, our margins will actually continue to improve on the reported basis, because we've been able to lock in good prices on those projects with relatively low land costs. I think that has kept margins in check. The other thing on construction is the faster we execute, lesser inflation hurts us. Fortunately, last year was a good year where we improved execution by 30% year on year, and we have less to execute going forward in terms of deliveries in what is locked as compared to we would have if construction would have been poorer in the year. So I think that's one way to really hedge against inflation. And regulatory risk in this business is part of the business. The way to ensure that is we are disciplined, compliant, don't overstretch ourselves, and keep our things and bringing that into the move along, improving our processes for compliance, improving our systems for compliance, that more and more of that becomes more formalized in the company, and we have been doing that. Second, on the senior living piece, around what we intend to do, I think the senior living piece we are intending to grow across markets. We have picked up 5 projects that we need to launch in the next 12 to 24 months, having a GDV of more than 6,500 crores in those 5 projects across Chennai, Bangalore, and the Bombay-Pune region that we have. We look for more projects in the NCR region. We are looking for more in Chennai and Bangalore as well, and the Bombay-Pune region as we speak. What we plan to do is have senior living at multiple price points where we straddle a larger variety of price points catering to different socio-economic category of customers with different projects. And on the tier 2-3 on premium homes, I don't think we intend to do more new cities of tier 2-3. We will continue to do work in the existing markets of Jaipur, Bhiwadi, and Jamshedpur, whereby Bhiwadi to us is really an extended part of NCR. If you would consider Kalyan to be a part of Bombay from MMR market, Bhiwadi is effectively an NCR market. And in Jamshedpur and in Jaipur, we'll continue to keep looking for JVs and executing as we've been doing earlier.
Okay. My second question.
Sorry, go ahead, Sukrit, please.
You've pretty much answered all the questions. The second question to Mr. Duggar is, what type of capital allocation and risk management frameworks are being applied in 2027 to balance working capital requirements with funding for new housing projects? Any hedge against interest rate and raw material volatility? And any buffers put into place to sustain liquidity for long-term cycle in real estate development? Thank you.
Sukrit, Varun here again. Vikash and I looked at it. We don't look at capital allocation from such a complicated perspective at all. I think there is Vikash has put together a very robust capital allocation framework in 2 things in one: location level measurement of our returns to make sure that our capital is performing, and also when we are allocating capital, we look to not land bank, launch our projects within as quickly as we can by going for making our design, going for approvals and launching. So we are not land banking, so that's not something. And the second bit is to make sure that construction is mostly financed from customer advances, so we don't have really interests to work with or liabilities to handle on that nature, and also go through a project within a 5 to 6 year framework once it's launched. If we do that, I think we are more or less okay.
Yeah, just to add to what Varunji mentioned, I think we always chase profitable growth, so the ROE remains the single most and the strongest metric basis which we, and of course the GP margin, roughly 30% that we have talked about in the past, remains the single most critical which we evaluate the project economics. So basis that only we look at allocating capital, and we have spoken about this. We are allocating more and more capital towards the senior living segment. We want to increase that segment of the business more and more. And coming back on working capital thing, I think we have got strong momentum going as far as generation of operational cash flows are concerned. And so most of the working capital requirements are being met through our customer advances. And any need-based requirement, if at all it arises, then we go for construction funding. But we are pretty well placed as far as working capital management is concerned.
Thank you very much, and best wishes.
Thank you, Sukrit.
Thank you. We take the next question from the line of Rohit from iThought PMS. Please go ahead.
Yeah, hello. Good morning, Varunji, Karthi. One question I think I've asked this many times, and I think I continue to ask this. So, sir, if I look at your presentation on page 26, so we have this land available, right, which is now, like, we've been selling around 2.5 million square feet every year. So, जो बचा है land, that is pretty much 26 million 25 lakh square feet. If I look at the, so of course I know that you have ongoing phases and existing projects as well. But just from the, like, continuing the growth perspective, and I think we had a few things which were under, I mean, there were CPs and all going on, and so for the land that we were, that we had initially signed up. So if you can maybe talk a bit about that, because I think next 2-3 years, the next phases will all get over, and given land buying is a very long-term kind of a thing. So how do we think about that?
Thank you, Rohit, for pointing that out. So two things, along with that 26 odd lakh square foot that we have on page 26, you're excluding Milakpur in that, and rightly so. We have another 40 lakh square foot which is of ongoing phases, which is 66. What is also not included in this deck is in April we signed up another 2 million square foot in the Mumbai-Pune near our Ashiana Housing project in Badgaon. So that adds another 20 lakh square foot, so that takes it to 86. And then there is another project of about 11 lakh square foot in Bangalore, which we have sort of done title diligence, done MOU, and there were some CPs for the landlord to do. On that, there has been progress on the CP movement. The CP that needed to be resolved, the tricky issue of the CP has been resolved. There is only procedural matters left in it. I think maybe another couple of months for that to get resolved, and then we will execute the definitive documents. But in my head, I consider now that project very much 99% likely. So with that, I think we get to about 96 lakh square foot in total, which is about 4 times of our annual throughput right now. We will 4 times is just enough to sort of maintain the annual capacity. We will need to improve this by adding more this year, and we are targeting to add more lands this year. I think the senior living pieces is where we will continue to focus. and add more opportunities. As I've already mentioned earlier, in senior living, we see land opportunities, we see places where we can find viability. We are in active discussions in multiple places, and hopefully we'll add more and get that going.
Okay. So that's good to hear, sir. And I hope the Bangalore project sort of also gets you a new geography, which will really help us in the coming years. So the other question was, sir, I mean, now next 2-3 years. So just from the, I mean, we will probably report very decent profits in the next 2-3 years, given all the deliveries will now be reported in the numbers. Any broad thought process in terms of like how much will you sort of look at from a land point of view? I mean, let's say that is your capex. So like how much is that capex, and how much are you sort of going to keep? I mean, any other things, let's say buyback or anything else? I mean,
broadly,
because it will be a substantial amount.
It will be a substantial amount. So right now the thought is deploy as much as we can in growing the business rather than returning back capital to shareholders either by form of buyback or dividends. That's the intent as of now. As I said, the senior living is a place where I think we'll deploy a bulk of this capital, and we will like to keep some otherwise also available for opportunistic things. As I said, let's say in Gurgaon, I think we are quite confident that we'll be able to build a decent brand and a good brand with premium pricing when we deliver our projects. We've gotten to, let's say, where we are in the bottom of the top tier of brands in Gurgaon. We want to get into a higher tier there for the product we are in. And as we deliver our product, we think we'll be able to get pricing. When that starts to happen, I would like to have the opportunity of doing large transactions in these large markets. So we would like to keep cash on the books for that as well. So given sort of that thought, I think it's not something that we'll do large buybacks or large dividends. Dividends will remain on absolute terms will grow. I don't per se they will not grow, but capital allocation will be focused on growing the business, if that's the way to.
No, I absolutely endorse that, and I think that's the right way to do it. And sir, just one question.
I would request you to join back the queue for follow-up questions.
Fair enough. Sure.
Okay. Thank you, Rohit.
Thank you. Ladies and gentlemen, in the interest of time and fairness to others, we request you to restrict to 2 questions per participant. We take the next question from the line of Ishita Lodha from Swan Investments. Please go ahead.
Hello, sir. Thank you for the opportunity. My question is with respect to the recent announcement that we made on Mahindra World City that we decided to terminate the lease. So can you please explain why did we not go ahead with this?
Yeah. Hi, Ishita. So the Mahindra World was a subject to some conditions precedent that Mahindra World City in Jaipur had to get done. They needed to get their social infrastructure layout approved so that they could carve out the residential parcels that they wanted to sort of sell to other developers. Unfortunately, it took like I think over 18 months we were with them. They were not able to get those approvals due to, I would say, exigencies outside of their control as well, given the situation on approvals there. And since they were not able to get those approvals, we were not able to go ahead with the transaction. And we thought since there was not enough timelines, also visible timelines on approvals, we thought it was better to sort of right now terminate the lease with an agreement with a view that in case that happens in the future, we can always restart discussions with them, given that we enjoy very good relationships already. We have done 2 transactions with them in Chennai prior to this innovation.
Okay. So in the presentation on page number 26, there is one, the title is Land Available for Future Development, which shows 22.7 acres of Aranya project, MWC Chennai. So this is different from the one that is got cancelled?
Yes, this is different from what just cancelled. The one that got cancelled was for Jaipur. So Mahindra has 2 of these world cities, one in Jaipur and one in Chennai. We have done 1 transaction already in Chennai, which is going on, which is a project called Ashiana Vatsalya. And Aranya is right next to Vatsalya, and that transaction is fully concluded. We are in the launch, land to launch phase that we call within the company. That is going on.
Okay, thank you so much. Yeah.
Thank you.
Thank you. We take the next question from the line of Sinclair D'Souza from Lalkar Securities. Please go ahead.
Hello, sir. Am I audible?
Yes, Sinclair.
So as senior living projects grow across India and people get more familiar with senior living, so as competitors will also increase, right? So then how is Ashiana planning to differentiate itself from other competitors?
Sinclair, Vikas here. So I think senior living, the way we look at it is more of a structural story, the way it is unfolding gradually, with it gaining more and more acceptability among the senior urban living population of the country. So I think that's where the opportunity lies, that if more and more players participate, I think the size of the industry grows. Rather than thinking it through a lens that more and more competition will arise, I think if more and more serious players join in, I think the industry overall, the size will increase, it will gain, and players like us, or for that matter any other serious player, will also stand to gain. That's the way we look at it.
I would add further, Sinclair, that we enjoy a very good brand equity, and have a track record of delivery. And I think people, when they are buying off plan, their confidence on the brand and its capability to deliver not only the ready product, but also the capability to operate and maintain and manage the development later on. We have that, and right now also the competition that is coming in. We are not seeing, outside of a couple of developers, we are not seeing very large scale developments the kind we do, with the amount of amenities, the quantum of and the quality of amenities that we are doing. And the size generally is not prevalent. More is prevalent to do 2 acres, 3 acres, 4 acre developments, which by nature of land size, the amenities get comparatively lesser than, let's say, a 12-15 acre project. I think that is also something I would just bring to light, that the kind of projects we are doing right now nobody else is doing, because you have to commit a lot more capital and take a lot more risk, where we have sort of now figured out what to do. So we are more and more comfortable with doing larger projects. Yeah.
Got it. So, and one more question is, how do you all see this war affecting like people's perception, like for buying houses currently?
So I think very difficult to comment. I think we have no capabilities to analyze impact of such geopolitical situations within and say what will happen in the future. We just look at what is happening today, and anything else we see which is more factual and structural. So what impact of the war, I don't know. What I can definitely say though, from a senior living perspective, and one of the reasons why we are shifting more and more our business towards senior living, aging in India and increasing financially independent seniors in India is a fact and given. Okay, that's just how demographic profile is. People are living longer, health is better, fertility rates are lower, financial savings have increased. So seniors who retire now will have wealth rather than financial dependence on the next generation. All of this is sort of clear and a fact today. And it's a fact today, and that's what we are relying on. We have no capabilities to say what the real current geopolitical situations or any future geopolitical situation, the impact that will have on our business. We'll end up quoting news sources and opinion makers. Otherwise, we read that you have access to as well. So nothing further.
Yes, sir, got it. Thank you.
Thank you. Thank you.
Thank you. We take the next question from the line of Saurabh Kumar from Scientific Investing. Please go ahead.
Hello, sir. I have two questions. First question is on senior living, and my understanding is new to the company, so correct me if I'm wrong. Right now, I think we build apartments and we sell it. But from a service perspective also, it is going to be a very, very big market. So in long run, do we have any plans? I know we are doing some kind of services, but I don't think that is very significant. But over 5 to 10 years, do you see annuity-based services kind of model where the company will be participating? That is one. And second is, I think we have done very well in terms of how the balance sheet has scaled up. If I can take a number, I think our inventory is 4 times up in last 7 years without taking much risk on the balance sheet side, which is a commendable performance in a commoditized sector. So when we look 4, 5, 6 years down the line, how do you see this inventory again going up from current levels given the kind of plans we have? These are the two questions.
So honestly, on the second part, we never thought about how our balance sheet would be today, 5 years ago, in this terms of how inventory would scale up. Overall, hopefully we continue to scale at a good pace because our overall construction momentum has sort of built up, and we should add to inventory. I believe that the senior living business will add to growth in the organization, and we believe senior living can be a really big play in the country. At the moment of time, we don't think the annuity-based, leasing-based model is the way for us to go, given the low sort of yields that are there in the country, and therefore, they're just not attractive to the attractive from a return perspective. Indians much prefer to own their own properties, and also, I think given the lack of a proper leasing structure in the country, if you're older, you actually would want more permanence for your house. You are less willing to move, and if I'm 70, I don't want to be shifting homes and moving. So the propensity to rent from that perspective becomes lesser because we don't have a long range leasing deposit kind of a structure and a model yet evolved which is financially viable. So in the medium term, which is let's say up to the 5-year term, I don't see leasing to become a big business for us, or a services-based business which becomes a large driver of profitability. The profitability in the next 5 years will continue to come from home sales. How it will change after 5 years, I really do not know.
Sure, this is all the best. I'll come back to you.
Thank you so much.
Thank you. We take the next question from the line of Shovan Dey from Riva Private Wealth Managers. Please go ahead.
Hi, sir. Good morning. Hello. Am I audible?
Hi, you are audible.
Yeah, sir. Regarding the path to a 20-plus reported ROE in FY27, so which project hand over the primary drivers for this target? Like, what is the biggest execution risk to those specific sites today?
So I would say But in general, we need to hit most of these numbers, right? Even if one or two slips, it can be a large dent. What I would say is probably Ashiana Malhar Phase 2 and Anmol Phase 3 have the least impact because they are lower margin projects. Other projects are all decent margins. Now, depending on their revenue contribution, you can decide which one is more important. That sheet is more in front of you. So let's say Ashiana Amara Phase 2 with 290 crores of revenue is a lot more important than, let's say, Ashiana Prakriti in Jamshedpur with 102 crores of expected revenues. But I think we are on track to get to more than 20% reported ROEs for the year. There is some room for slippage here as well, given if we maintain even the that margin that we have gotten this year. I think with a lower revenue, we'll hit 20% ROEs.
Thanks.
And we think year-on-year margin should improve actually this year. So there is a little bit of room there from a 20% ROE perspective.
Okay, got it, sir. Next question. We recently acquired 38 acres in Chennai and Maharashtra, adding to an estimated of 3,200 crores of sales potential for the senior living portfolio. What are the margins on these new parcels, and what do you expect that per square foot structurally expand as this vertical scales up?
So let me put it this way, including the one more project that we have done in Vadgaon in Maharashtra and the Bangalore parcel, which put together have a GDV of 6,500 crores in senior living. I would say these projects at the project level, before, let's say, general and administrative expenses of the corporate, should operate at about 30-35% of margins. Now, how the corporate fixed costs will behave as a percentage will depend on total top line. But that's what we would expect to do that. I think we can look at about gross profit margins of between 35 and 40%, and you're looking at about 5-6% of selling costs, and therefore about 30-35% of margins at the project levels on average. Some of them would be higher, some of them would be lower, depending on our pricing power within those markets and our ability to position the product correctly.
Okay, got it. Sir, and what are the...
Chauvin, I would request you to please join back the queue for follow-up questions.
Okay.
Thank you. We take the next question from the line of Anubhav Goel from Cosma Ventures. Please go ahead.
Hi, sir. Sir, congrats on the recent large deal done for senior living. Sir, I just wanted your thoughts on various state government policies. I think there is this Maharashtra housing policy of 2025, which brought out attractive terms for senior living for developers and buyers. So, just wanted your color if do they materially improve your economics? Are you now seeing more and more players enter this sector? And are other state governments also now following up on these lines?
Other governments have not followed on the lines of Maharashtra yet. People are coming up with different regulations for senior living. Some of them is also tightening the regulations around services, so they are more consumer oriented, which is also a good thing because the more confidence that customers will have that developers will actually deliver, the more the business sector will do well. The policy of Maharashtra is also not yet notified, in the sense the rules are not framed. The policy framework that need to be incorporated in the development control regulations have not yet been incorporated. So the policy is right now, I would say, more of an intent and less of an operational policy that you can actually utilize. As and when it becomes operational, I think what it will do for us is it makes it easier for us to look for parcels which are more suitable for senior living. Because we are looking for a little bit more scenic areas, more neighborhoods which have a different charm, if that's the way to put it, for seniors, because they don't have to be in the city anymore. Those neighborhoods will become a little bit more easier to work with, and more parcels might come up for development if this policy goes through. And the other thing that Maharashtra has also done within Maharera, they have defined what all you need to fulfill to be able to market yourself as a senior living project, which is also a good thing, because that regulation also creates a little bit of regulation which will give more faith to the customer that this senior living will be actually what it is. So I would say overall the policy framework right now is encouraging for senior living. Yes, there are some places where over-regulation, over-ambitious regulations are a concern in some states, but I think those will also get resolved as things move along.
Got it, sir. And so just a follow-up on the previous question someone asked of slow-moving projects. So you have mentioned we can expect 35-40% growth going ahead. And previously you have said that FY27 margins should be better than FY26, and FY28 should be materially better because all the low-margin projects, and I think Malhar is the only slow-moving project which can impact this. So, sir, as of now...
slow moving is the wrong word. Low margin is the better word, right? It could be moving fast with, yeah. So go ahead.
So, sir, apart from Malhar... Yeah. So, apart from Malhar, is there any other 1-2 projects you see where this can marginally impact the improvement in margins?
Different projects have a different margin profile. So Anmol is the other one which I said, which is the last phase is getting delivered in this year, where the margin profile is significantly lower than what we generally underwrite. Now, there are some projects which will be at our general levels, and some projects going forward which are, as we have had some projects which have been below our general levels, there are now projects which are significantly above our general levels. So there will be volatility in the margins, I would say, on a quarterly basis for sure, but the margin profile for a full year basis in 27 will be better than 26, and the margin profile in FY28 will be better than 27 overall. That's the general expectations.
Thank you. We take the next question from the line of Ankit Shah from White Equity Investment Advisors. Please go ahead.
So thank you for taking my question. My first question is, you mentioned that we acquired a land parcel in Mumbai, Pune belt, maybe Vadgaon, in April. I missed that part. Can you substantiate that a bit?
Okay, so we have acquired about a 28.5-acre parcel on the old Mumbai-Pune highway in a place called Vadgaon. It's very close to our current project, Ashiana Amod. We'll do a senior living project here, about 20 lakh square foot, approximately, let's say, 1,800 to 2,000 crores of GDV. And,
Okay, that's helpful. Sir, if you can share guidance for pre-sales for FY27 and the launch pipeline, the phases and new projects.
New projects, we are looking to launch Ashiana Oma, Ashiana Tattvam, and Ashiana Aranya. Ashiana Oma is a premium housing project in Jaipur where all approvals have been received. We should launch in the next couple of months. Ashiana Aranya and Ashiana Tattvam are slated for launch in the Q4 of this year. And phase launches is hard to say, but basically we have phases. From phase 3 should get launched this year, and phases in all our senior living projects like Advik, Amod, Vatsalya, Swarang, we should be launching at least one phase in each of the senior living projects is what I would expect this financial year. So it is, we should have decent launches in the financial year. The pre-sales target for this year is 2,200 crores that we are targeting. But I would say more importantly, I think we are really looking to grow senior living. Senior living is targeted to cross 700 crores. I think senior living sales have been growing at a CAGR of more than 50% for the last 5 years. If that's the way to put it, we have gone from 100 crores to 570 crores in a 5-year period in senior living. I think the key metric that we are looking for pre-sales is to really rev up senior living. The more it does well, the more the long term is defined, because to me, it's a structural story. It's a structural change in India's demographics, particularly in the western and the southern part of the country, and some of it in the northern part of the country. I would say the eastern part of the country eastern and central part of the country remains very young demographically. But these parts of the country are changing structurally, both in financial independence of seniors and overall percentage of seniors and urban seniors. That's the pre-sales. I think we are really, even though it's a smaller subset, I think that's taking a larger attention of the management team, if that's the way to put it. Because that's where the future lies for us.
Perfect. So in this context, we were planning a project with Epoch in Bhiwadi. Can you update on that, please? Okay.
So with Epoch Elder Care, we have signed up our assisted living part of the business. So senior living has two pieces in the business. One is what we called independent living, active living, or they are called active adult communities in the world. These are for folks who are seniors but they're active. Okay, they don't need assistance in their day-to-day life. You are creating amenities for socializing, for wellness, for companionship, for activities, for constructive, purposeful living, and this is 99% of our senior living business, if I were to say, and which is basically where we make our profits. In our senior living projects, we throw in a tad bit of assisted living, because our independent living customers might, in the future, at some point of time, require assistance and care services and caregiving. And so we've built these at our projects. They're not necessarily our focus for our customers from a profit perspective. It's a sort of a value-added service that we're providing. So in one of our projects, instead of doing it ourselves, we have tied up with Epoch Elder Care, who specialize in doing this, to see if we can outsource this activities to free up management bandwidth to focus on the active piece itself. So right now, we are running two large care homes. One will be this in Bhiwadi called Nirmay Care Homes, gone to Epoch, and the other will be in Chennai in Ashiana Shubham. That care homes we plan to manage ourselves, and to see what the difference we have when we have outsourced one of the projects out, to see, and then take a call on future strategy of care homes.
Thank you. We take the next question from the line of Shubham Segal from SIMPL. Please go ahead.
Hello, hi. Am I audible?
Yes, hi Shubham, you are audible.
Thanks for the opportunity. So you already mentioned the launch timelines for Aranya and also.
I do apologize to interrupt you, Shubham, but your audio is not coming in clear. Could you please use your handset?
Yeah, is it better now?
This is better. Please go ahead.
Yeah, sure. Okay. Yeah, so could you just provide any rough timelines for the so the Pune Karjat one, the Bangalore one, and the Pune Vadgaon one, and also so if we see the delivery timelines, so currently for FY29 and 30 and let's say 31, we are roughly around 800 to 1,000 crores each. So will these new land bank projects be, like getting delivered in those financial years, or like are we planning on any other projects to be delivered then? So like just these two questions.
Okay. So so I'll walk you through Ashiana Oma, Ashiana Tattvam, and Ashiana Aranya are to be launched within this financial year. I clarified earlier as well, Oma within the next couple of months, and Aranya and Tattvam in Q4 of this financial year is what we're targeting. The other three projects, which is Wabarle, Vadgaon, and Bangalore, we're targeting to launch in FY28. There will be build-up in FY30 and FY31 deliveries and values there. Most of it will be built not through new launches of projects, but launches of existing phases. I would say all the phases that we have, that we are looking to launch, which would be around, I think, 25 odd lakh square foot, we would probably look to wrap them by FY31, whether it's Ashiana Vatsalya, Ashiana Advik, Swarang, Ashiana Aroham, all of those launches by FY31 we would look to launch that up. So that will definitely add up there. Of these new project launches, I would say Ashiana Oma definitely should get delivered within FY30 or FY31, partly, not the full project, but the phase which we will launch in the next couple of months should definitely get delivered by FY30, I would say. And the other projects of Aranya and Tattvam, FY30 would be difficult, but I would expect some part of it to come in 31, and the other three projects which are going to get launched in the next financial year will probably go to 32. So some part of Aranya and Tattvam should also come into FY31. So there will be these two financial years will build up. You will see every quarter something or the other getting added to these two financial years is what I would say.
Okay, got it. Thanks for the answer. Just one last question. So currently our realizations are on a higher end just because of our launch of Aroham. But going forward, how do we see our realization trajectory moving up? Like blended one, because senior living would be higher, but on a blended basis.
On a blended basis, I think our realizations, if you look at what our full year realizations, the quarter realization is what Aroham is really impacted because of the significant there. Right now, I think we are at 9,000 for the full year. Let me just open this up if I don't want to get my quoting. Yeah, we are at 9,000 for the full year. Yeah, 9,000 for the full year. I would say our realizations should be in this 9 to 11,000 kind of a range. I would say maybe hopefully should move to about 10,000 on a blended basis as senior living starts becoming a larger profile, and let's say Jamshedpur and Jaipur, which are relatively lower price markets, also become a little lesser in quantum, though even Jamshedpur and Jaipur have now moved to 7,000 plus for us as markets, I think. And in senior living also, Vikalji is just pointing me out to add that you're premiumizing as well. So the Ashiana Aranya and Ashiana Tattvam are a lot more premium products than what we have historically done in senior living. So there is a premiumization story playing out. So I would say 10,000 rupees a square foot is definitely something we should look to get to.
Okay, got it. Thanks a lot.
Thank you.
Thank you. We take the next question from the line of Gata Jain from Anandnath Skycon Private Limited. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Just wanted to know the land area and price for Oma.
Say that again, please.
I just wanted to know the land area and price for Oma, the project.
Land area of Oma is around 11 odd acres, I would say 10 acres. 10 acres is Ashiana Oma. We're not launching the entire project, I think. And roughly the pricing should be, we haven't, I think, closed the exact pricing, but in the 7,500 to let's say 8,500 range, it will land somewhere, or 7,500 to 8,000 it will land. Exact pricing is yet to be concluded fully, I think.
All right. Thank you so much.
Thank you.
Thank you. We take the next question from the line of Varun Bang, an individual investor. Please go ahead.
This is Varun Bang from Bandhan Life Insurance, actually. So this first question, with respect to our Panvel project, what is the upfront investment in the Panvel project, and what could be the realization assumption for Panvel? And given that this is our first project in Panvel, do we have to rely on channel partners for sales, or we can drive direct sales, how we are doing in other senior living projects?
Hi Varun. We don't generally give out individual project investment details like this publicly, so I'll refrain to do that. I think, and the pricing of Panvel has also not been concluded yet. I think we'll launch in Q4. I think there the pricing will get more and more ascertained closer to launch. We give some GDV ideas basis some pricing, but I don't want to get into the exact sort of pricing as of the moment. We will be doing it at the highest end of any senior living that we have done, that we can tell you. And will we have channel partners? I think senior living we have started using channel partners, but the reliance on channel partners is very limited. The senior living market is sold mostly directly because it's more of a specialized sale to a specialized customer. And we already have a lot of customers from Bombay. Ashiana Amod in Pune, 50% of our customers there have been from Bombay recently. And even Utsav Lavasa has had significant Bombay customers historically. And so I would say majority or nearly or material sales should happen directly, and the channel partner should contribute some in the beginning, some parts in the beginning.
Got it. And just to my first part, with respect to our upfront investment, if that is not possible, if you can just broadly share, if we are targeting 15% PAT margin, 15 to 18% PAT margin, can you share ballpark breakup of this 82 to 85%, the remaining portion? That would be helpful.
I wouldn't like to share that on a project-specific basis. That's the only thing, Varun. But let me put it this way. As I said, we were looking at about 35 to 40% at the gross profit level of projects in general, about 5% of sales and marketing. So you're looking at a project level margin of 30 to 35. You take out general and administrative costs after that, any financial costs we have, and take out tax effectively to get to PAT margins. And I said general and administrative costs will vary depending on actually what the revenue would be in a particular year. On the direct costs, which is, let's say, about excluding sales costs, about 60 to 65% of revenue, we would look at about 5% of what I call project overheads, which are approval costs, architect costs, we have construction cess, environmental fee, OC fees, all of that put together, which is like soft costs of about 5%. Hard construction costs would vary between the 40 to 50% ranges, and land costs will vary between the 10 to 20% range. So that's the breakup that you will have. So some projects might have a 10% land cost with a 45% construction cost. Some might have a 20% land cost with a 40% construction cost.